Preparing for a Cigna financial analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to work as a financial analyst at Cigna. I'm an analytical professional with experience building forecasts, explaining variances, and presenting recommendations to non-financial partners. Cigna interests me because its businesses combine healthcare impact with complex financial decision-making across insurance, pharmacy, and services. In my previous role, I improved a monthly reporting process and identified a cost trend that helped management act earlier. I would bring that same curiosity, accuracy, and business partnership mindset to Cigna while continuing to deepen my healthcare finance knowledge. While answering, connect your analytical training, healthcare interest, communication skills, and relevant experience to Cigna's insurance and Evernorth businesses. Explain why the company's mission, scale, and data-driven decisions genuinely motivate you. Question 2. What do you know about Cigna and its business segments? The Cigna Group is a global health company whose major businesses include Cigna Healthcare and Evernorth Health Services. Cigna Healthcare focuses on health benefits and related insurance solutions, while Evernorth provides services such as pharmacy, care, and benefit solutions. Financial analysis must recognize that these businesses have different revenue models, margins, utilization patterns, and regulatory considerations. That diversity makes segment reporting and operational metrics especially important when assessing consolidated performance and forecasting future results. Make sure to cover Cigna's healthcare orientation, the Cigna Group structure, Evernorth Health Services, Cigna Healthcare, insurance offerings, pharmacy services, and the importance of understanding segment-specific revenue, costs, and risk drivers. Question 3. Why is financial analysis especially important in the healthcare industry? Healthcare financial analysis matters because small changes in utilization, treatment intensity, or member mix can materially affect profitability. An analyst connects premiums or service revenue with medical costs, pharmacy expense, administrative costs, and enrollment trends. The work also supports affordability and regulatory commitments, so maximizing profit is not the only objective. I would evaluate both financial outcomes and operating indicators, then explain whether a variance reflects temporary utilization, structural pricing pressure, or execution issues. In your answer, talk about medical costs, utilization, premium pricing, member mix, provider economics, regulation, affordability, and the need to balance financial performance with quality and access to care. Question 4. Walk me through how you would build a monthly forecast for a healthcare business. I would begin with actual results and establish a driver-based model rather than simply applying a growth percentage. Key drivers could include membership, premium yield, utilization per member, unit cost, pharmacy trends, headcount, and other operating expenses. I would incorporate seasonality and known business changes, document assumptions, and compare the forecast with prior guidance. Finally, I would run sensitivities, review the output with business owners, and track forecast error to improve the next cycle. Be sure to mention historical trends, enrollment, premium or service revenue, utilization, medical cost ratios, pharmacy expense, administrative costs, seasonality, assumptions, sensitivity analysis, and reconciliation to actual results. Question 5. How would you analyze a favorable or unfavorable budget variance? I first quantify the variance and compare actual results with budget, forecast, and prior year. Then I separate volume, price, mix, timing, rate, and productivity effects to identify the real driver. For example, higher medical expense may result from membership growth, increased utilization, or an unfavorable risk mix. I would validate the data, discuss operational context with stakeholders, assess whether the issue is temporary or structural, and update the outlook with a clear recommendation. Focus on quantifying the variance, separating price, volume, mix, timing, and productivity effects, validating source data, speaking with operators, determining root cause, and recommending an actionable response. Question 6. What healthcare metrics would you monitor when evaluating Cigna's performance? I would monitor membership and retention, premium or service revenue, medical cost trend, medical care ratio, administrative expense ratio, adjusted income, and operating cash flow. For pharmacy-related operations, prescription volume, specialty drug trends, rebates, and gross-to-net economics would matter. I would also examine metrics by product and customer type because aggregate results can conceal mix shifts. The best dashboard combines financial measures with leading operational indicators that explain why performance is changing. Mention enrollment, premium revenue, medical care ratio, medical cost trend, administrative expense ratio, adjusted income, retention, pharmacy volume, service utilization, cash flow, and metrics appropriate to each business segment. Question 7. What is the medical care ratio, and why does it matter? The medical care ratio generally measures medical costs as a percentage of premium revenue. If premiums are $100 million and medical costs are $85 million, the ratio is 85%. A rising ratio can indicate higher utilization, pricing pressure, unfavorable member mix, or provider cost inflation. A declining ratio may reflect better pricing or lower claims, but it requires context. I would analyze the metric by product and period, then connect changes to enrollment, utilization, and regulatory requirements. In your answer, define the medical care ratio, explain its relationship to premiums and medical costs, discuss favorable and unfavorable movements, and mention enrollment mix, pricing, utilization, and regulatory context. Question 8. How would you forecast medical costs and utilization? I would decompose medical cost into membership, utilization frequency, and cost per service. Historical claims provide the foundation, but I would adjust for seasonality, benefit changes, provider contracts, diagnosis mix, high-cost claimants, and emerging treatments. I would compare recent experience with long-term trends and use credibility where data is limited. Because healthcare outcomes can change quickly, I would prepare base, upside, and downside scenarios, clearly documenting assumptions and monitoring actual emergence. Make sure to cover historical claims, membership, utilization frequency, unit cost, seasonality, diagnosis mix, provider trends, high-cost claims, emerging treatments, credibility, and scenario analysis. Question 9. Explain the difference between revenue, operating income, and cash flow. Revenue measures the value earned from premiums, services, or other activities during a period. Operating income subtracts operating costs from that revenue and shows business profitability before items outside operations. Cash flow measures actual cash generated or consumed, so it can differ because of receivables, payables, reserves, capital spending, or non-cash expenses. I use all three together. Revenue shows scale, operating income shows economics, and cash flow tests liquidity and earnings quality. Focus on revenue recognition, operating profitability after operating expenses, non-cash items, working capital, timing differences, capital spending, and why analysts should evaluate all three measures together. Question 10. How do the income statement, balance sheet, and cash flow statement connect? Net income begins on the income statement and flows into retained earnings on the balance sheet. The cash flow statement starts with net income, adjusts for non-cash items and working capital movements, and explains the change in cash shown on the balance sheet. For example, recognizing revenue without collecting cash increases receivables and income but does not immediately increase cash. Understanding these links helps me detect inconsistent assumptions and explain performance accurately. Be sure to explain net income, retained earnings, working capital, non-cash adjustments, cash reconciliation, reserves, and how a transaction flows through all three statements. Question 11. What is the difference between generally accepted accounting principles earnings and adjusted earnings? Generally accepted accounting principles earnings follow standardized accounting rules and provide the primary basis for financial reporting. Adjusted earnings typically remove selected items such as certain restructuring costs, acquisition-related effects, or other items management considers unusual. I would never assume an adjustment is automatically appropriate, I would review the definition, recurrence, materiality, and reconciliation. Adjusted results can improve operating comparability, but generally accepted accounting principles results remain essential for transparency, consistency, and understanding the full economic cost. Discuss generally accepted accounting principles: consistency, management adjustments, unusual or non-recurring items, reconciliation controls, transparency, comparability, and the importance of avoiding adjustments that obscure recurring operating economics. Question 12. Describe a financial model you have built or improved. I built a monthly expense forecast that linked headcount, salary rates, hiring dates, bonuses, and vendor commitments instead of relying on prior period percentages. I standardized source data, separated assumptions from calculations, added checks for missing employees and duplicate records, and created base and downside scenarios. After reviewing it with department leaders, forecast preparation time fell by roughly 30%, and variance explanations became more specific. The experience reinforced that a useful model must be transparent, controlled, and decision-oriented. Talk about the business question, data sources, model structure, assumptions, controls, scenario capability, stakeholder use, measurable improvement, and how you validated accuracy before distributing results. Question 13. How would you assess the financial impact of a new healthcare contract? I would model the contract's expected volume, pricing, utilization, unit costs, implementation costs, overhead, and cash timing. I would clarify whether risk is fully insured, shared, or fee-based, because that changes earnings volatility. Next, I would test sensitivities for enrollment, medical trend, retention, and service costs, then compare expected returns with capital and operational requirements. I would also assess strategic fit, execution capacity, and downside protection before recommending approval rather than focusing only on headline revenue. In your answer, cover membership or volume, pricing, expected utilization, provider and pharmacy costs, implementation expense, administrative overhead, risk sharing, cash timing, sensitivity analysis, and strategic fit. Question 14. What would you do if your forecast materially disagreed with a senior manager's estimate? I would first confirm that we are using the same period, definitions, and source data. Then I would compare assumptions line by line, identify which drivers create the difference, and present the evidence without making it personal. If uncertainty is substantial, I would show a range with clear sensitivities rather than claim false precision. I would listen to the manager's operational knowledge, agree on follow-up actions, document the judgment, and escalate only when reporting integrity or material risk requires it. Mention respectful challenge, evidence, assumption comparison, data validation, scenario framing, listening, escalation when necessary, documented judgment, and commitment to updating the forecast as facts change. Question 15. Tell me about a time you found an error in financial data. During a monthly review, I noticed that an expense category was unusually low compared with both budget and prior year. I traced the issue to a mapping change that excluded several invoices from the reporting extract. I quantified the impact, informed my manager, corrected the file, and reran the analysis before distribution. I then added a month-over-month completeness check and documented the mapping logic. The key lesson was that analytical skepticism and simple reconciliations can prevent misleading conclusions. Focus on how you detected the issue, quantified its impact, traced the root cause, communicated carefully, corrected the reporting, and implemented a control to prevent recurrence. Question 16. How do you ensure accuracy and control in Excel or financial reporting? I start by reconciling source totals to the general ledger or approved operational report. I keep inputs, calculations, and outputs clearly separated, use consistent formulas, label assumptions, and build checks for totals, blanks, duplicates, and unexpected movements. I maintain version control and request an independent review for material deliverables. I also document methodology and protect sensitive data. Accuracy is not just avoiding formula errors, it is creating a process another analyst can understand and reproduce. Be sure to mention source reconciliation, formula checks, locked assumptions, version control, independent review, exception reports, audit trails, documentation, and careful handling of confidential healthcare and financial information. Question 17. How would you evaluate an acquisition or investment opportunity for Cigna? I would begin with strategic fit, whether the opportunity strengthens capabilities, scale, member value, or growth. Financially, I would analyze revenue quality, margins, cash flow, customer retention, required investment, valuation, and realistic synergies. I would separately model integration costs, timing, regulatory considerations, and execution risks. The recommendation would include base and downside cases, sensitivity to assumptions, and potential earnings accretion or dilution. A compelling strategic narrative is not enough unless the economics and risks support the price. Discuss strategic rationale, market position, revenue quality, cost structure, valuation, synergies, integration costs, regulatory considerations, risks, cash flow, accretion or dilution, and downside scenarios. Question 18. What is working capital, and how can it affect a healthcare company's cash flow? Working capital reflects operating assets and liabilities that affect near-term cash, including receivables, payables, accrued expenses, and claims-related balances. A healthcare business may report revenue and earnings while cash is delayed in collection, or cash may be consumed when claims and vendors are paid before customer receipts arrive. I would monitor aging, collection patterns, payment timing, and reserve movements. Strong earnings growth can still pressure liquidity if working capital investment grows faster than operating cash generation. Explain receivables, payables, accrued liabilities, claims or benefit obligations, timing mismatches, operating cash conversion, liquidity monitoring, and why growth can consume cash even when reported earnings increase. Question 19. How would you explain a complex financial result to a non-finance stakeholder? I would lead with the headline and business implication, then explain the 2 or 3 largest drivers using plain language. For example, instead of saying margin deteriorated because of mix, I would explain that lower margin membership grew faster than higher margin membership. I would use a simple bridge or chart, quantify each effect, and distinguish facts from estimates. I would finish with the recommended action and invite questions, adapting the level of detail to the audience. Mention starting with the decision, using plain language, leading with the headline, quantifying drivers, avoiding unnecessary jargon, tailoring detail, checking understanding, and ending with a clear action or implication. Question 20. What would you do if medical costs rose sharply while membership remained stable? Stable membership would not rule out significant cost pressure, so I would decompose the increase into utilization, unit cost, severity, and mix. I would examine inpatient admissions, specialty drugs, high-cost claimants, provider rate changes, benefit design, coding, seasonality, and whether a data issue or timing effect exists. I would compare actual emergence with forecast assumptions and estimate the full-year impact. Depending on the cause, actions could include pricing, care management initiatives, contract review, or a revised outlook. In your answer, investigate utilization, unit cost, high-cost claims, acuity, provider rates, pharmacy trends, coding, timing, data quality, product mix, forecast impact, and management actions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.